Good morning, everyone. Thank you so much for joining us today. I'm Anne. I'm one of the economists at REA Group. And today what I'm hoping to do is give you an overview of what we're seeing in the commercial market. So I'm going to start with a bit of an update on what we're seeing happening in the economy, particularly as it pertains to the commercial sector. And then I'm going to do a bit of a deeper dive into some of the main asset categories. So to kick it off, if we look at what's been happening with our economy in recent years, the answer is not too much at all. Economic growth has been very subdued over the past couple of years and is sitting well below long-term average levels. But what's quite interesting is when you look at economic growth on a per capita or per person basis, we have been firmly in a recession for 2 years now. So the overall size of our economy has actually been shrinking relative to the number of people in this country for a 2-year period. In other words, the actual reason why we have avoided a technical recession so far is to do with the extraordinary level of population growth that we have been continuing to see. If we look at what population growth did over FY23 and 24, Australia has never seen its population increase by so many people in such a short amount of time. And what's quite interesting is there's a bit of a lag in terms of the actual population data being released. But if we look at long-term arrivals as a proxy for what migration is going to be, we actually surpassed the government's own forecasts for population growth back in March this year. And in all my time of doing this, I have never seen, apart from the pandemic, a period in which population growth actually came in line with the government's own estimates. We always exceed that. As far as what's driving population growth, it's predominantly that net overseas migration. And this has implications for Australia in terms of what we need as far as housing, what we need as far as business is concerned. There's some really interesting shifts that are taking place. If we look at where that population growth is headed, WA is the state that has been growing the most rapidly. So WA saw the highest percentage growth in its population over both 2022, 2023 and 2024. That rate of growth of about 2.5% we're seeing at the moment is actually slower than what we were seeing a year ago, whereas up above that 3% level. If we look at number of people, though, Victoria is the state that is seeing the strongest population growth overall in terms of people on the ground. Now, Victoria was the strongest growing state over the 10 years pre-COVID, and it is forecast to overtake WA and return to being the fastest growing state over the coming years. If we look across the states, you can see that teal coloured bar, that net overseas migration, remains the primary driver in every state, but there are some interesting differences. In New South Wales, we always consistently see negative net interstate migration out of the state. Now, a lot of this has to do with housing affordability, and those younger professional aged people often leave New South Wales to move to more affordable states such as Queensland and Victoria. On the other hand, if we look at Queensland, we see that net interstate migration is always very strong, of course, driven by that affordability piece, but also we see retirees moving up into that state when they end their career. Now, I think Victoria is the one that is going to change over the coming years. And the main reason for that is to do with housing affordability. So Melbourne, which used to be the second most expensive capital city to live in, is now one of the cheapest. So it was overtaken by Brisbane. It's now also been overtaken by Adelaide and Perth. So it's one of the cheapest cities to buy a house or unit in. As far as rent goes, Melbourne's also the second cheapest capital city to rent in, behind only Hobart. So I think that's a factor that's going to draw more younger working age professionals into the city. And I think that that does bode quite well for Melbourne over the longer term. If we look at what's happening with inflation, there is good news. Over the past 6 months, we've seen that rate of inflation hold steady in the Reserve Bank's target band. However, if we look at how much the cost of things has risen over a 5-year period and we compare that with wages, unfortunately, people are having to allocate a much higher proportion of their income towards the cost of living than they were in the past. So the overall cost of things has increased by about 21%, but wages have increased by 16%. Now, We had a bit of a surprise last week. I think all of us were expecting the Reserve Bank to cut interest rates, particularly off the back of the monthly inflation indicator, which showed that inflation had come in lower than expected. But as the Reserve Bank mentioned, that is only a monthly indicator, and they want to wait until they have firm evidence for the June quarter that inflation remains in that target band. So on the 30th of July, we'll have a very strong indicator of whether the Reserve Bank is going to cut interest rates in August. It's more of a case of when, not if, as far as they've led us to believe. But of course, with the Reserve Bank, nothing's ever a sure thing. If we look at where interest rates are sitting, I think it's starting to have an impact on the commercial sector. We have seen demand start to pick up again following those first two interest rate cuts. But if we compare where interest rates are sitting now compared to the long-term level, you can see that they're still very, very high in a historical context. One challenge that we are seeing is that a lot of businesses are doing it very tough. And of course, high interest rates are a major factor here. In March of this year, we actually saw a record number of businesses enter insolvency around Australia. Now, from the commercial property sector's perspective, typically when we see rising insolvencies, we tend to see rising vacancy rates. And in certain sectors, we have been seeing this. It's not universal. And actually, despite the fact that we are seeing high insolvencies, it's not the full picture on its own. If we look at total unemployment, for example, you can see that over the past year and a half, it's sat very stable at around that 4% level. If we look around the country, however, there are some differences. Victoria has the highest unemployment rate in the country. It's also the weakest performing economy in the country. On the flip side, we've got places like Queensland and Western Australia, which have been seeing much better economic growth overall compared to Victoria. And also you can see that unemployment rate there still sitting well under that 4% level, particularly in Queensland. So why is unemployment still pretty low despite the fact that insolvencies are rising? Well, the answer to that is that for every business that's going under, we're seeing more than that number of business start up. And actually, if we look at the most recent number of businesses released, over the most recent financial year of data available, there was an increase of over 70,000 businesses across Australia. So the majority of new businesses, you can see from that chart, we've got a lot in the transport, postal and warehousing, which underpins industrial demand. The healthcare sector remains an outperformer. Construction, again, is supportive of industrial. And then we've got, you can see professional, rental, financial, administration. Those are industries that support the office sector. So there is some good news there. Even though it is a challenging environment for businesses to operate in, we're still seeing a very high number of new businesses starting up. As far as commercial property transactions go, we're still quite subdued. Now, we have started to see signs of things picking up. The most recent data we have available for the June quarter is just an estimate so far. It will be higher than this amount that you can see on the chart. We are almost at those pre-COVID average levels, which, considering where interest rates are sitting at the moment, is actually reasonably positive. As it has been the case for the past few years, it's the industrial sector that is primarily driving sales volumes in the commercial sector. You can see that sales of office assets in particular remain extremely subdued. And if we compare the sales of industrial versus those pre-COVID levels, they're still relatively high. So that's the sector that's really underpinning a lot of demand and transaction activity at the moment. Another interesting trend we've seen is that when it comes to the kinds of commercial properties that are transacting, we're seeing a lot more activity at the lower end of the market compared to the upper end of the market. So if you look at that sub $2 million category, there's been a lot more sales at that level happening compared to what we were seeing in the pre-COVID era. Similar story with that $2 to $5 million category. Where we haven't really seen the bounce back yet is in that higher end of the market. So in particular, that 10 million plus category, you can see that sales volumes are still relatively low compared to where they were, particularly during 2021 when the market was really peaking. Another interesting shift is in terms of where investors are deploying their capital. It's probably of no surprise to any Victorian listeners, but we actually have seen a decline in the share of total investment heading into Victoria. Tax settings are obviously a massive disincentive for buyer types in Victoria. In contrast, though, what we have been seeing is a larger share allocated towards Queensland in particular. So you can see Queensland and Victoria are now equal in terms of the proportion of investor capital that they're attracting. So with 2 interest rate cuts under our belt, this is absolutely playing into where cap rates are sitting at the moment. So if we look across all asset types, we've seen evidence of cap rate compression over the first half of the year. One exception to that is if you look at office cap rates, that compression that we've seen has really been centred amongst CBD office assets. When it comes to suburban office assets, we're still seeing evidence that yields could have further to rise. As far as listings on realcommercial.com.au go, it's a bit of a mixed bag. Overall, we haven't seen a significant year-on-year change. We have seen the number of properties being listed for sale down slightly, whereas the number being listed for lease has increased slightly. Now, I think that one of the reasons why we're seeing relatively higher for lease listings is to do with that increase in business insolvencies that we have seen. So in certain asset types, we have seen, for example, vacancy rates pick up a little bit, and that's translating into more lease listings. If we look at where inquiry is sitting, there is some good news. We are seeing a lot of interest from buyers. So we are seeing a lot of people doing that investigative stuff. So they're looking at assets online. We're seeing really high search volumes. We've seen inquiries pick up. Now, just because inquiries pick up, it doesn't mean that we'll see an instant increase in deals done. But I think that post interest rates being cut, there's definitely a sense that the market is turning. Now, the commercial market took much longer to respond to higher interest rates than the residential market did. And it was really only until recently that we were still seeing commercial values basically recalibrate. But if you recall that cap rate slide I just showed, we're now seeing some pretty clear evidence that prices are turning the corner, and that we're going to start to see values grow. And I think that once investors see that the market is shifting, we're going to start to see more say, okay, it's probably a good time to get in now. So all asset types, we actually had a record amount of inquiry over the most recent data available. And interestingly, we're actually seeing a bit of an increase in office inquiry, which to me was a little bit of a surprise, given that the sector still has a lot of risk. But if you look at how much office values have recalibrated in recent years, it could be investors who are seeking good value opportunities. Something that is a little bit of a shift, though, particularly compared to the pandemic years, is that those alternative asset classes have seen a bit of a decline in inquiries. So in particular, childcare and service stations, we aren't seeing anywhere close, well, service stations in particular, we're not seeing the same level of inquiry that we were seeing a few years ago. And over the past year, we've seen inquiries for childcare centres, pubs dip off a bit as well. Medical and consulting remains an outlier. And if you recall, when I was looking at how many businesses are starting, what employment is doing, the healthcare sector is poised to massively outperform over the coming years. Australia has a rapidly ageing population that is going to support the need for more healthcare facilities, and investors are taking note. Okay, so diving into the industrial sector, and what we're starting to see, and I'm seeing this pretty much across the board, is that we're seeing a bit more interest from overseas investors in the Australian market. Now, if we look at the total volume of industrial that has transacted, private investors remain the number one category, but you can see over the past 2 years, the proportion of investment allocated to the private sector has dipped slightly. And in contrast, we've seen offshore buyers account for a slightly higher percentage. If we look around the country at what's happening with industrial vacancy rates, for around 2 years now, industrial vacancy rates have been increasing. However, they are increasing off the back of a very, very low rate. So this is still a market that's performing well, but you can see that with the increase in vacancy that we're seeing across the country, the rate at which net face rents have been rising has slowed, and we have seen an increase in incentives. It's particularly notable in Melbourne. You can see that the rise in incentives is much stronger than the other capitals. And this is consistent with the fact that Melbourne has the highest vacancy rate in industrial right now. Some good news for the sector, though, is that one of the key reasons why we saw the industrial sector outperform during the pandemic was that rise in remote shopping and the need for logistics and warehouse space to accommodate that. If we look at how that trend is tracking, we are continuing to see a growing share of sales allocated towards online retailing. And this is particularly evident in the sale of food online. So this is proportion of total sales happening online. If we look at the dollar value of sales happening online, you can see that actually it has continued to rise. And again, it's that food sales that's really seeing the strong growth. So in May, we had the highest value of online food sales transacted in history. If we look at non-food sales, it is continuing to rise. It's still slightly below those peak levels that were reached during the pandemic, though. Now, the reason for this is obviously in part because things are more expensive, but the primary reason is to do with population growth. So even if the population, the share of online shopping that the population did remain steady, a growing population means that more people are buying things online, and this is going to continue to drive that need. So these are just the most searched keywords for those looking to lease industrial property on realcommercial.com. And we have seen a bit of a shift around in these words. So pre-COVID, storage wasn't even in the top 20. It then rose to be the #1 searched keyword for a good couple of years. It's now fallen down the ranks a bit. Crane has regained its top spot. You can see there are a few keywords in there that do relate to things like online food retailing, food, the #2 most searched keyword, and then things like freezer, cool room are also pretty high up there as well. Shifting to the office sector now, and just as we saw with industrial, offshore sales for office assets have increased and private investors have declined. We've also seen institutional investors over the couple of years have been present, but if we look at REITs, they're still largely absent when we compare their allocation to pre-COVID era. Now, vacancy rates remain a major risk factor for office investors. If we look at Melbourne, for example, where the vacancy rate is the highest, it's also seen the biggest change in recent years. So Melbourne used to have the lowest office vacancy rate in the country. It was sitting at around 3% in January 2020, and it's now 6 times that level. Similarly, Sydney had a slightly higher vacancy rate. It was around 3.5% back in January 2020 and is now sitting at 13%. Interestingly, some of our capitals have actually seen vacancy rates come down from pre-COVID levels. So a notable example would be Perth, which had an extremely high vacancy rate back in the late teens. And you can see that the vacancy rate has been consistently trending lower there. Similarly, Brisbane has been performing well, and we've been seeing that vacancy rate in Brisbane trend lower. Now, when we look at office occupancy rates, we had consistently been seeing growing occupancy rates from those extremely low levels that we saw during lockdowns over the pandemic. But when we look at what occupancy has done over the past 6 months, it's really held steady. And I think that where we're sitting at the moment is probably our equilibrium level that we're going to reach. I think In particular, if we look at Melbourne, where people were in lockdown for a much longer period of time, hybrid working is the norm. We're not really seeing too much of a shift in terms of the number of days that people are spending in the office. Those markets where people didn't spend much time in lockdown, we're seeing occupancy rates in some cases higher than they were back pre-pandemic. Now, I also think it's worth looking at these occupancy rates because from where I'm looking at this, Melbourne's lower office occupancy rate, I think, suggests that we're not going to see a major turnaround in vacancy rates in Melbourne anytime soon. Whereas on the other hand, if we look at where Perth, Adelaide and Brisbane are sitting, I think that this is going to continue to support recovery in those office markets. Throwing in the most searched keywords by renters, and you can see that 9B is in the #1 spot. Education's also up there, #8. We're also continuing to see office tenants really looking for premises that offer good amenity. So we know that people are much more likely to go into the office if they can implement that office experience with their actual personal lives as well. So for example, being close to childcare centres, access to gyms and cafes, those kinds of things are still really, really valued by tenants. So moving to the retail sector, and again, we've seen a bit of an increase in investment to offshore investors. And we've also seen more larger investors such as institutions, REITs, playing into the retail space over the past year. Now, a lot of this is being driven by sales of shopping centres. So assets that are anchored by supermarkets, for example, are being pretty competitively contested when they're coming up. And I think that from the investor perspective, if we look at, what's really going to drive the performance of assets, we've got population growth, people need to eat. And so assets that are exposed to non-discretionary retail, such as groceries, are going to continue to see pretty strong demand. If we look at sales of shops in contrast, they're still relatively subdued compared to historic levels. They're still sitting a little bit under where we had been in terms of pre-COVID averages. Now, one of the reasons why I think there's a little bit more nerves around retail strips shops is to do with the fact that the cost of living, high interest rates have driven down consumer spending. So there's some good and bad news. If we look at total retail capita turnover per person per capita, you can see that it has seen a really, really sharp decline from 2022, which was when interest rates first started increasing. However, as I've mentioned a few times, the fact that there's more people living in Australia is actually helping to keep that total retail turnover spend pretty stable. However, even though that total spend is pretty stable, that spend is being allocated more so to that non-discretionary category. So discretionary retailers are still really struggling with the fact that people are cutting back on those luxuries, those things they don't really need. Some good news, though, is that with 2 interest rate cuts under our belt, we're starting to see a recovery in household spending. So in 2023, the amount that households were saving in Australia fell to the lowest level on record. It was sitting at around that 1% level in some states. And since that time, we have been seeing a bit of a recovery. We're almost back at that sort of pre-COVID level now. And I think that that's good news. It's going to help to support further recovery in the retail sector, particularly over the second half of the year when we see more interest rate cuts come in. So finally, a bit of good news is that we have been actually seeing CBD retail vacancy rates come down. Now, I think one of the reasons for this is even though we know that people aren't going into the office 5 days a week necessarily, a lot of our CBDs have actually been seeing an increase in foot traffic, which is being driven by more residents. The classic example of this is the Melbourne CBD, who, even though it has the lowest office occupancy rates, foot traffic in the Melbourne CBD is now well above where it was pre-COVID. So there's still a lot of articles out there talking about how, Melbourne's doing it so tough. And obviously Melbourne is still doing it really tough in terms of a lot of our economics. But as far as people on the ground go, the fact that there has been such strong population growth within that inner Melbourne area in particular is one of the reasons why we're starting to see more retailers looking for space in CBDs. And on Real Commercial, we've been seeing this trend as well. So during the pandemic, we saw a higher proportion of retailers looking to take up space in regional areas, in suburban areas. That's now shifting back a bit, and we're starting to see retailers looking for really good deals within CBDs themselves because they can see that that return has happened. Okay, so that's the end of the slides. I think there's potentially a few questions that might have come in. Let me see. Okay, so the first question is around the economic indicators that I'm watching most closely. I think a really big one that we're looking out for is what's happening globally. Now, the US is in, there's no better word than it's in chaos at the moment. And I think that tariffs do pose a risk to Australia, absolutely, but they also pose an opportunity. One thing that we've seen is that there's actually been a pretty sizable increase in investor demand coming out of the US into Australia. So we've actually seen the amount of US investment into Australia pick up. And we're also, when we track where people are looking, there's been a big rise in searches coming out of the US as well. So I think that that's one potential opportunity. Another question, have I seen a shift in investor appetite when it comes to regional versus metro? Yes. As I mentioned, when it comes to CBD retailers, we're seeing a bit of a comeback. With office as well, we're seeing more focus on CBDs than we are on regional areas. But on the flip side of that, there are some regional markets in Australia that have seen a really big increase in demand in recent years. In particular, in Queensland, we're seeing a lot of growing interest in some of those markets, such as Townsville and the Gold Coast and Cairns. These are markets that are seeing very strong population growth. They've also seen really strong growth in residential demand. And I think that that's also, as populations move into these areas, that's also supporting business opportunities. Another trend that feeds into that is that trend of more people moving out regionally than back into the cities. And we have been continuing to see that post-COVID. So the proportion of people moving away from cities into the regions remains higher than the other way around. And again, that's going to support demand and need for commercial properties. Next question is about international investors and their interest in Australia. Definitely. So as I showed, when it comes to the proportion of buyer types, offshore investors are accounting for a higher share. If we look at the markets that are driving that, North America is a big one, and Asia as well is a growing one. And I think with interest rates now coming down in Australia, with our strong population growth rates, with the US market being a much riskier investment destination, we're going to continue to see pretty strong investor demand from offshore. It's still sitting well below the levels that it was pre-COVID. So I think, again, there's room to grow there. Next question, are there any sleeper sectors? I think there could be an opportunity in terms of if you look at a lot of assets out there, and one good example would be something like a secondary grade office. They're high risk at the moment. The risk of vacancy is very high. A lot of these buildings perhaps need to have a lot of money spent on them, but the cost of construction has increased so much in recent years that in some cases, there are assets out there that are selling for below replacement cost. And I think that for investors who are able to weather longer periods of vacancy or who are looking for opportunities for upgrading an asset, I think that secondary grade office could potentially be an opportunity.